This is Rekha. Today we are going to see about the nature and kinds of company. Before diving into the topic, let us see about the role of company. Company in general, it plays a vital role in the global economy because it drives innovation, it creates jobs, it contributes to the economic growth. When a company usually indulges themselves in manufacturing. So with the help of the exports what they are doing, the country is able to generate revenue. It increases the national income, GDP, and all those things. The main goal of any company is to generate profits by offering goods or services to its customers. So in order to achieve this, it has to invest in resources. What are the resources we have? Capital, labor, and technology. And also, it strives to maximize the efficiency in its operations. So let us get into the topic, what a company is. A company is a business organization. It can be created by individuals or group of persons to conduct business. So, and it has different forms like sole proprietorship, you have partnership, you have joint stock company, you have, and it operates in various industries and sectors. So here they have given the general connotation about what a company is. It referred to as an association of people. And one more thing, what they have given us, a company needs to be registered under the Companies Act 2013. Before it was Companies Act 1956, now it is Companies Act 2013. And any other organization incorporated with the Register of Companies and subsequently not registered cannot be considered as a company. What does it mean is, they should be keep on updating the details of the company and they should re-register themselves under the Companies Act 2013. The definition of company is, according to section of the Companies Act, a company means a company formed and registered under this act or existing company. What an existing company is? An existing company means a company formed and registered under any of the previous company law. And the act, as I told you before, it represents Companies Act 1956 and 2013. Let us see about the features of company. Features of a company are broadly classified into separate legal entity, limited liability, perpetual succession, artificial person, common seal, separation of ownership and management. Let us discuss about its features in detail. The first and foremost feature is separate legal entity. It means a company is legally distinct from its members. That is, one who invests capital and runs a business is called as an owner. But once the company got registered or incorporated under the Companies Act, then from that point of time, the owner is different and company is different. That is, the company has its own assets and liabilities. The company which is invested, the capital which is invested by the owner in the company itself is treated as a liability, to the company, and because of that only interest on capital is paid to the owner by the company as it is a separate entity. For instance, take Tata company as an example. Tata company has its own common seal and identity. Even after the demise of its founder, it is going on, allowing Tata company to own property, enter into contract and conduct business in its name. So, once if a company got registered, it has its own nameplate, it is considered as a separate entity. So, the next feature is limited liability. Here it is given as shareholders' liability is limited to the extent of their investment. What does it mean is, it means shareholders of a company are responsible for company debts up to their investment amount only. Their liability is limited to the face value of shares subscribed by them. That is, at the time of winding up of the company, if the assets of the company are insufficient to meet the claims of the creditors, those who owed money to the business, claims of the creditors, the shareholders cannot be asked to pay anything more. We'll discuss this in detail in kinds of companies, because in that we have limited companies, unlimited company, limited by shares, limited by guarantee we have. So in that we'll discuss about this in detail. Next thing what we have is perpetual succession. A company's existence is independent of the lives of its members. That is the main thing about this one. What do you mean by this is, for example, if the CEO or board of director of a company pass away, the company will be going on forever and that position will be replaced. So, company continues to operate despite changes like death, insolvency or resignation of shareholders or directors, ensuring stability and uninterrupted business operations. So, nothing is going to affect the company. The business will go on and on forever unless otherwise it is winded up. Next feature is artificial legal person. This means it is a legally created artificial person with its rights and obligations. It can enter into contracts and it can file a case on anybody, and anybody can file a case against the company, though it requires human agents like CEOs, chief executive officers, directors and employees to function and make decisions. And the next one what we have is transferability of shares. So the shares of a company are freely transferable and it can be sold or purchased in the share market. Next one is capacity to sue and to be sued. It means in case of any discrepancy with any company, you are entering into a contract, if you have any discrepancy, if you have breach of contract, the company can file a case against that particular person, and also that particular person can file a case against the company. Both can do. And common seal. Common seal means a company may have a common seal which acts as its official signature on legal documents. As it doesn't have any physical existence, as it is an artificial person, the common seal company will have whenever they are entering into a contract, and it is considered as an official signature. And the last one is number of members. As per the Companies Act 2013, the minimum number of persons needed to start a public company is 7, and for a private company is 2. In case of public company, you don't have any limitations in the maximum number of persons. It is infinite. But in case of private companies, it is restricted to 200 actually. So we are moving on to the types of company. So the basic 3 types, what you have is private company, public company and one person company. Let us see these things in detail. Private company, as we discussed now, there must be minimum of 2 persons and maximum of 200 to form a company. It restricts the right to transfer shares. It also prohibits any invitation to the public to subscribe for any shares. It doesn't have any rights to invite the general public to invest in its company actually. It can do it privately to the persons who they know, their friend circle, their relative circle, friends of friends. With them they can collect money and invest in their business. They are not supposed to raise capital from the general public. Next one is public company. There must be at least 7 persons to form a public company, and there is no maximum limit. Generally speaking, any member of the public may acquire shares in a public company. Any person for that matter, any citizen can, even NRI can be a member of a public company. Next one is one person company. As the name itself suggests, one man holds practically the entire share capital of the company. But they have to meet the statutory requirements, right? So in order to meet the statutory requirements, that person may ask his relatives or friends to hold 1 or 2 shares each. It means one control the entire company. One is going to control the entire company. So he is the one who is going to bear the profit and loss of the business. Next one what we have is they are classifying the companies under various criteria. First one is classification on the basis of incorporation. Next one is classification on the basis of liability, and the next one is other forms of companies we have. Let us see about the statutory company. What a statutory company is. If a company is incorporated by means of a special act of the parliament or any state legislature, then such companies are called as statutory companies. In general, they are formed to carry out some specific, particular, special public undertaking. For instance, railways, gas, electricity generation, water works, all those things. Instances of statutory companies in India are Reserve Bank of India, RBI, Life Insurance Corporation of India, LIC, and Unit Trust of India. So the next one we have is limited company. So it is, as I told you, it is subdivided into 3 categories. So let us see one by one. First type comes in is limited by shares actually. This is a common type of company. This is a company where the liability of its members is limited to the amount fixed by the memorandum of the company. What they are telling? The liability is limited to the amount fixed by the memorandum of the company. What it means? The company's ownership is divided into shares. Usually, whenever a company is in need of capital, what they will do? They will try to raise capital from the general public by issuing prospectus or initial public offering. So when they when they are planning to collect it from the general public, so what happens when they invest their money, when the general public invest their money in the business, the company's ownership is divided into shares. People who buy these shares are called the shareholders, that is owners of the company who own a part of the company. When it comes to liability, shareholders are only responsible for the company's debts up to the value of their shares at the time of winding up of the company. Example, imagine Tata Consultancy Services issues 1000 shares at rupees 10 each. So how much they need? They need an additional capital of 10,000 rupees. What you have done is, you have invested 100 shares in it. You have invested 100 shares in TCS company. So how much does it cost? It costs around 1000 rupees. If the company is going to dissolve their business due to any loss, then you are going to lose only rupees 1000 what you have invested. There is no need for you to pay the company's debt. Excess, there is no need for you to pay. So whatever you have invested as shares, till that limit only, your liability is limited. Next is company limited by guarantee. What it means? Instead of shares, members agree to pay a fixed amount if the company gets into financial trouble. That is, if the company is going to wind up, if the company is going to be a failure, if the company is going to be in loss, in that case, what the members will do is, they'll agree to pay a fixed amount. This type of company usually doesn't aim to make profits for owners, but serves a purpose like charity, clubs or non-profits. For example, if a charity organization is formed and it has 50 members and they have agreed to pay rupees 1 lakh each if the charity is going to be in debt. If a charity's debt needs to be paid off at the time of winding up, say for example, each 50 members are there and each one is 50 members are there and each one is ready to contribute 50 members are there and each one is ready to contribute 1 lakh rupees each. In that case, these members don't own shares and don't get profits. They only promise this fixed amount which is agreed at the time of formation. So in case the company is going to wind up, at that time all the 50 members will come forward and pay 1 lakh from their part. And the next one is unlimited liability. Unlimited liability means the shareholders are personally responsible for all the debts and financial problems of the company. If the company is going to be in debt, then shareholders might have to use their personal assets like their house, savings to pay off those debts. There is no limit to how much the shareholders can lose. I'll tell you one simple real life example we'll see now to understand the difference between limited liability and unlimited liability. See, you are going to buy a ticket for a musical concert, say for example, and the concert is going to get cancelled due to heavy rain. And you have already bought the ticket, you have purchased a ticket. In that case, you will be losing only the ticket price, that's all. This is called as limited liability. Say for example, the ticket price is going to be 100 rupees. Then your liability is limited to rupees 100, that's all. This goes with company limited by shares. If the face value of the share is going to be 100, if the company is going to be winding up, or else it is going to be in a loss, then you are going to lose only your face value of the shares, the amount what you have invested. In case if you are the one who is organizing the music concert, then you have to pay all the debts yourself. It costs way more than the ticket price actually. It is called as unlimited liability. You are taking the whole risk of running the show, and if it is going to be a failure, then you have to face all the losses actually. So this is about the classification on the basis of liability. Then next one, other forms of companies what you have is holding company, subsidiary company, and then Section 8 company, government company, and foreign company. This holding company and subsidiary company goes hands in hands with each other. Holding company, first I'll tell you what it is. The company that controls or owns another company. The company that owns or controls another company is called as a holding company. Subsidiary company is a company that is owned or controlled by a parent company. So that is, I'll go with an example. Say for example, there is a large technology company. It's a huge technology company. It's named as Big Tech Incorporation, and it owns a smaller company called Gadget Maker Limited. Say for example, you have one company which is called as Big Tech Incorporation, and it owns a smaller company called Gadget Maker Limited. In this case, Big Tech Incorporation is a parent company, which is a holding company, and Gadget Maker Limited is a subsidiary company. Gadget Maker company is a subsidiary company. And the next one what you have is Section 8 company. Section 8 company is a type of non-profit organization. Section 8 company is a type of non-profit organization. It is registered under the Companies Act 2013 in India, and it is established purely for charitable purpose. That is like promoting education, healthcare, environmental protection, or social welfare. And one more thing is, it is eligible for tax exemption. It is eligible for tax exemption under 80G and 12A of the Income Tax Act. And the next one what you have is government company. What a government company is? The Company Act actually defines a government company as a company which is not less than 50% of the paid up share capital is held by the central government or state government, or governments partly by the central government, partly by the state government, and one or more state governments even joined together can invest in this company. So any company which have a paid up share capital which is held by any of the governments, central government, state government, or combination of both the governments together, or combination of two state governments together, it is called as a government company. It is also called as a subsidiary of a government company also. This government company is. And the next one what you have is foreign company. What do you mean by a foreign company? Foreign company means a company incorporated outside India. It is incorporated outside India and having a place of business in India. Like our Indian companies will be registered and incorporated under the Companies Act 1956 or 2013. 1956 or 2013. Here what happens in case of foreign companies, they have the incorporation in foreign, but they have a place of business in India. So the company provides that where not less than 50% of the share capital is held by Indians, Indian citizens actually. As it is situated in India, the share capital at least 50% should be held by the Indian citizens actually. So when a foreign company is going to run its business in India, what document should they have? Every foreign company within 30 days of the establishment of the business, that is, they have incorporated themselves in foreign and they are going to start a business in India, they are going to have a business place in India. In that case, within 30 days of establishing a business, they have to furnish all the below details to the registrar for registration. What they should furnish: a certified copy of the chartered memorandum, article, statute, everything should be submitted to the registrar. And one more thing, if the instrument is not in English language, then a certified translation should translate all these things. And then full address of the registered or principal office of the company should be submitted. List of directors, secretary of the company with particulars to name, nationality, everything should be included in this. And name and address of all the persons who have invested their capital. 50% of the capital should be by Indian citizens. No, I told you, no. So all those persons' address should be furnished. And the full address of the place of business also should be furnished. Other than these, what they are supposed to do? Every foreign company, unless it is exempted by the central government, unless if they don't have any exemption, all the companies should file with the registrar every year 3 copies of their balance sheet and profit and loss account. So whatever the Companies Act is prescribing, all those documents, all those financial accounts, balance sheet, P&L account should be submitted to the Registrar of Companies. So every company, and one more thing is, the main thing is, every company, foreign company, should exhibit outside their office or its place of business its name and country of incorporation should be exhibited in English and in any one of the local languages where it is situated. It shall also have the name of the company and country of incorporation in business letters, heads, bill heads, letter pads, letter papers. In all notices and official publications, they should include their country of incorporation in English as well as in one of the local languages. So if they are planning to wind up the company, in that case, all foreign companies carrying on business in India may be wound up by any order of the court. It can also be wound up even if it has been dissolved or ceased to exist according to its own law of incorporation. In case where they have incorporated, that particular country is not allowing them to run the business here, in that case, they can wind up the business. That's all. Thank you all.